Checking account. A checking account is the most common, everyday bank account. It is designed for frequent transactions like paying bills, swiping a debit card, writing checks, and receiving direct deposits from work. The money stays easily accessible, and most accounts come with a debit card and online banking access. Interest, if offered at all, is usually very low because the bank expects you to move money in and out regularly. It exists mainly for convenience and daily cash flow management. Savings account. A savings account is built for storing money rather than spending it. Banks pay interest on the balance, which makes it slightly more rewarding than a checking account. Withdrawals are often limited each month, encouraging people to keep the money untouched. Traditionally, savings accounts were passbook-based at local branches, but today they are mostly digital. They are simple, safe places to build emergency funds or save toward short-term goals. High-yield savings account. A high-yield savings account works like a regular savings account, but offers a significantly higher interest rate. These accounts are often provided by online banks that operate without physical branches, allowing them to pass cost savings to customers. The money remains liquid and protected under deposit insurance in many countries. For people who want their savings to grow faster without taking investment risks, this account fills that gap. Money market account. A money market account combines features of both checking and savings accounts. It usually offers higher interest rates than standard savings accounts, while allowing limited check writing or debit card use. Banks often require higher minimum balances for these accounts. They became popular as a way to compete with investment money market funds, giving customers flexibility with slightly better returns. Certificate of deposit. A certificate of deposit, often called a CD, is a time-based savings account. You agree to leave your money untouched for a fixed period, such as 6 months, 1 year, or even 5 years. In exchange, the bank pays a guaranteed interest rate that is usually higher than standard savings accounts. Withdrawing early typically results in a penalty. CDs appeal to people who want predictable returns and do not need immediate access to their funds. Current account. A current account is similar to a checking account, but is more commonly used in some countries and often tailored for businesses. It allows unlimited transactions and is built for frequent deposits and withdrawals. Interest is rarely paid, and banks may charge service fees. Its primary purpose is to support active money movement rather than savings. Student account. A student account is designed for young adults in school or university. These accounts often waive monthly fees and may offer small perks like overdraft protection without high charges. Banks create them to build long-term relationships with customers early in their financial lives. They function like regular checking accounts, but are structured to be more affordable for students. Joint account. A joint account is shared by 2 or more people. Couples, business partners, or family members often use it to manage shared expenses. All account holders typically have equal access to deposit and withdraw funds. While it simplifies shared budgeting, it also requires trust because each person can usually use the money independently. Business account. A business account is specifically created for companies, freelancers, or entrepreneurs. It separates personal finances from business transactions, which is important for taxes and legal clarity. These accounts often include tools for payroll, merchant services, and higher transaction volumes. Keeping business money in a dedicated account helps maintain clear financial records. Trust account. A trust account holds money on behalf of someone else, managed by a trustee. It is often used in estate planning, legal arrangements, or by professionals such as lawyers holding client funds. The account follows specific legal rules that control how and when money can be distributed. Its purpose is to protect assets and ensure they are handled according to agreed terms. Custodial account.
A custodial account is opened by an adult for a minor. The adult manages the funds until the child reaches a legally defined age. These accounts are often used to save for education or future expenses. Once the child becomes an adult, control of the account typically transfers to them. It introduces young people to financial ownership while maintaining oversight during childhood.
Offshore account. An offshore account is held in a country different from where the account holder lives. People use them for international business, currency diversification, or privacy reasons. While sometimes associated with secrecy, offshore accounts can be fully legal when properly declared and taxed. They are regulated under the laws of the country where the bank operates. Foreign currency account. A foreign currency account allows you to hold money in a currency other than your home country's currency. This is useful for international travel, cross-border work, or global business. It helps reduce exchange rate conversion costs and protects against currency fluctuations. These accounts have become more common as global transactions have increased. Online-only account. An online-only account exists entirely through digital banking platforms without physical branches. Customers manage everything through apps or websites. Because overhead costs are lower, these accounts often offer fewer fees and better interest rates. They represent the modern shift toward fully digital financial services. Interest-bearing checking account. An interest-bearing checking account combines everyday transaction features with the ability to earn interest. These accounts usually require higher minimum balances than standard checking accounts. They appeal to people who keep larger sums in their checking accounts but still want some return. It blends convenience with modest growth potential.